Ricardo, ¿me escucha? Ok, buenas tardes, Coral, Gabriela. I'm having a few problems here with the setup. How does it sound? How do things sound? I can't get my AirPods to connect. I don't know why. They don't connect. Oh, maybe this way. Testing. Is it loud? How's the sound? So I don't have my microphone today. I just have my AirPods. Good? Okay, I trust you. I'm going to try not to yell or speak loudly or abruptly. Okay, so you have a test on Wednesday. You have a test on Wednesday, and the test will be on Unit 3 and Unit 4. And I wanted to spend today looking at Unit 4. I left you with the exercises to look at, explanations. This is a solution of the UAir case, and I think we left off here. Am I right? I believe we left off here. Oh no, maybe a few pages back. A few pages back. Okay, so I stopped with you. This was my other class. So I stopped with you back here. Is that correct? Just going to clean up a bit here. So let's do this, solve this together so you know all the elements of solving a case, if you didn't already, for capital budgeting. Okay, so let's go through this. So I hope you had a chance to look at these notes and get started. I believe we may have stopped here. Is it true? It's been a week. Just verifying in my notes. Yeah, so what we did, all we managed to do was to solve for income. And I explained that we can use this worksheet approach in Excel or on a, you can write handwriting to get to this stream of cash flows for income after tax of the earnings before depreciation and taxes. So with this, we then can simply solve for the NPV, or the PV, I use PV, of income. And it's $23.7 million. So that's the income, but we have to invest. So how does that performance compare to what you have to invest? And then finally, we have to look at the benefits of the write-offs, right? The tax shield, the tax savings. So to get the second piece, investment cash flows, if we look back, we said for investment cash flows, we would include the airplanes purchase, and then the airplane sales at the end of the project. And if we have to also include investment cash flows. So these are investment from the perspective of the firm that they have to finance, this project and take out from other operations of the firm to conduct the project. So I'm going to show you how to get these amounts. So here we have, I'm going to use this one here. So here we have horizontally inventory, which is an asset, right? It's a short-term asset. And we've computed here that immediately we need $600,000 worth for inventory. We need cash, right, to pay off any suppliers or any people contracted to maybe repair the planes, okay? We also have to have money set aside for accounts receivables, then accounts payable and taxes payable. So these are current assets, these are current liabilities, current in that they are resolved within a year. That's immediately. Then by the end of year one, now obviously these amounts will change or fluctuate in the year, but by the end of year one, we want to have $850,000 in inventory available. By the end of year one, we want 1.5 million in cash, etc. Okay, so this is what we want. And then year two and year three, and final year, really important, is in the final year, the project ends and the funds that have been allocated to this project are released back to the firm. So we don't need anything for this project. So let's put these together, and by computing, what we're computing is called the net working capital, NWC, requirements. So add these and subtract these, and what do you get? Okay, let's see. You said 900,000. Are you sure? So you can put these in Excel as well. No, that's not it, Coral. What? Can you do it again? All right, so Alexa's got it. Okay, keep going. What's the next value? You guys are spending a lot of time just adding those and subtracting them, right? Okay, here we go. Alejandro gave me 1,000,000. And 2,400,000. And then again. So you should get, I'm going to get the values from here. Okay. All right, so you've calculated the net working capital requirements, current assets minus current liabilities. My penmanship is terrible right now. I'm just going to write CA minus CL, okay? And now what do you do? Now we want to calculate the incremental cash flows that we'll need from year to year. So what more do we need? And immediately up front, we need to have $1.6 million. And then in the next year, we need an additional $800,000. How did I figure that out? I take 2.4 million minus 1.6 million and get 800,000. And what I've calculate is the change. So the increment, right? Change in net working capital required. And then from 2.4 million to 3 million, I need an additional 600,000. But then from 3 million to 2.2 million, I go down. $800,000. And then to end the project, we release $2.2 million back to the firm. Any questions about that row? Okay, so then finally, these are the changes required each year. So we need to set aside 1.6 million, then an additional 800,000, then an additional 600,000, and so on. And that means that each year there's an investment in net working capital that looks like this. So we have to write in cash flows, right? Our amounts are in cash flow. So that's a negative cash flow that's out of pocket for the firm into this project. So that's a negative. This will also be a negative. This will also be a negative amount. And what we're calculating are the net working capital investment cash flows. This will be a positive amount, again, from the perspective of the firm. This money is cash inflow into their pocket. And that's it. Questions? So these amounts are the amounts that go into my investment worksheet. Okay, let's go back to the investment worksheet. Well, let's go forward to it. I mentioned, well, actually, let's go here to where I mentioned what we have to include. So we have to include, like I said, the purchase of the planes, the sale of the planes, and the investment in net working capital. So these are the amounts that we just computed. So let's, the purchase of the planes we know is 40 million. That's not anything we have to work with. The one thing we have to discuss is this, the sale of the planes, a salvage or residual value. In terms of taxation, we have to determine if there are capital gains after the sale. To determine that, we need to compare this market value that's what we expect the market value will be. We have to compare to the book value of the planes. Now remember, we're depreciating the planes, so in the books, its value will have diminished. So let's figure out what that is. And here's the table to do it. So for your test, you'll need to make a depreciation table with these headings. These numbers are the rates of depreciation that come from the maker's table that I showed you. The maker's table you can use is the one on the platform, the Moodle platform. I don't have Moodle loaded. Anyway, you have to look back and remember the maker's table. And these are the numbers, they're 3 digits for the 7-year depreciation. And I have one set of values included here. This is what you want to compute. You want to calculate the big D, D for depreciation. Depreciation is computed as the rate times $40 million. So the rate times $40 million is equal to 5.7 million. So this is the amount that you can claim as an expense for taxes. This represents the wear and tear on the planes and diminishes the value of the planes from 40 to $34 million. Yes, Gabriela, you can do the depreciation table in Excel. So I'm going to ask you to submit your Excel tables to me, and you can do that with, in Excel format, not a PDF, so I can see your formulas that you used. Yes, so this is your depreciation. And this represents the undepreciated cost of capital. That's what UCC stands for. So so let's ignore the last column for a moment, and let's continue with the next. So I mentioned this is going to be from the maker's table, but it was explained in the case that this is 28.6%, but in the first year we were allowed to depreciate only half. So that's to adjust for the fact that some people will purchase it earlier in the year, some people less. Business owners, right? Firms will purchase their capital or their equipment in different points of the year. Now, let's say someone purchased the capital, purchased the planes in January. In January, a purchase will result in planes that are depreciated more by December than a purchase made in December, let's say. Okay, so you see there's an incentive to purchase equipment or make those investments for your operations or for any kind of projects your company is taking on. There's an incentive to make them in December. If you don't de-incentivize that, and the disincentive is to say, okay, we want as a government, right, you like to have more stability throughout the year in operations and purchases, in cash flow, not cash flow, but the word I'm looking for, velocity of money in the economy. So you want to spread things out. And so this, by only allowing depreciation of half the purchase price, that disincentivizes purchases all made in December, right? So anyway, that's the idea of the half year. This is called the half year rule. All right, so now it goes back to the 28.6%, but it's double declining. And this number actually comes from a realization that your capital is it's the value, the book value is diminished. So this number helps you calculate what you can actually depreciate off the 40 million. So all you have to do is take this number and multiply it by 40 million, and what do you get? So you could make the Excel table to calculate all these, but let's just do it manually for now. So look at that. In the first year, we're actually able to claim an expense of almost $6 million. In the second year, did I do that correctly? You're going to take 40 million times 0.245. Oh, I did do it wrong. I knew the number was in almost 10 million. It has to be double. I'm not sure what I did wrong there. So 9.8 million, so almost $10 million you can claim as an expense, and you'll see how this affects tax savings. So now you take this undepreciated cost of capital amount and you subtract 9.8 million and you get what? $24,480,000 is left. So the third year, we take 0.175 times 40 million. Now you could do this without the maker's table values, all right? Just using the rate of depreciation and compute this yourself. But this is actually much easier. So that's just a clean $7 million. Well, Alejandro, there's going to be other questions. It's not all going to be Excel. Excel you can just use for a couple of parts of the question. Oh, because you want to do the whole thing in Excel? No. There are other questions on the exam. It's not just going to be about this. So, but whatever you can do in Excel, if you want to do solve the whole thing on Excel, you'll see there's some problems you can't solve completely on Excel because there are side effects in labor shortage problems where the side effects are perpetual. You won't be able to solve it completely in Excel, so you have to use annuities. But yeah, if you find you can use Excel for parts of the question or some questions, sure. I prefer that you solve the problems the way I'm doing it, but if you still get the right answer, that's okay too. So when I say the way I prefer it is that you solve it in 3 parts. Anyway, let me finish this problem. So after $7 million, $17.48 million. And then finally, it's $5 million. So this amount is the book value of the planes. There are 4 planes. So how much for each plane? So we put them all together. How much for each plane? If you take that amount and divide by 4, it's 12.48 million or 3.12 million per plane. Does that number look familiar? That number is precisely the amount that we estimate we can sell the planes for. So it turns out where this is the market value, the market value is just equal to the book value. Now that doesn't happen every time. Maybe the case was written so that they would be the same, all right? So the case is prepared so that they were the same, imagining that it's not too much of a big deal, that they're a little bit different, and they don't want to complicate your calculations, because what it amounts to is what I'm going to show you next. What you have to account for is that in this case, there's no difference, but if you sold if you sold the asset for less than the book value, then you could say you have a loss, a capital loss. And so you would save taxes, or save on, because of the tax system, you would reduce your taxable income and realize a tax savings. If you sell the asset for more than the book value, then you have to report essentially a capital gains that results in you paying taxes, right? So there's this extra calculation that needs to be made to determine the salvage at the end of the project, or when you're selling the asset. So in the fourth year in this project, we're going to include on our investment worksheet salvage plus the effect on tax savings that result, remember, from depreciation. In this case, it's going to be this extra tax savings if we have a book value that's higher than what we actually sell it for. This is going to be positive. Otherwise, this will be a negative. Okay, so this is the extra term you need to add in. In our case, this will be 0. Okay, this is going to be 0 in our case. All right, so what do we have? This is the investments worksheet, the airplanes
$40 million. Remember, everything's in thousands of dollars. And we have this as the salvage value at the 4th year. And then these are the amounts of net working capital. And so we can calculate this in each of the years, and we can calculate where we got $24+ million for income. For investments, we find that it's negative 32 million. So it looks like we have a loss, right? Like this is a negative NPV project unless, because this is 24 minus 32 million, unless our tax shields offset this difference. So what I've done here is I put the tax shields calculated in the table. How did I get the tax shields? Tax shields are computed as, if you remember our computation of net operating cash flows, it's just the tax rate times the depreciation amount. So these are the depreciation amounts here. You have to take them and multiply them by 40%, which is the tax rate. So that's it. So TC, the corporate tax rate, is 40%. And that's what you would get. So these you can actually save as a result of being able to depreciate, which depreciation is not a cash flow, but it reduces the taxable income, which realizes tax savings. In the first year, that's going to be an amount of $2,288,000. In the second year, it's going to be about $4 million, and then it goes down. In the third year, 2.8, and then $2 million. So I calculate and I find out that that is $8.789 million, right? So it turns out if you put these together, 1, 2, and 3, you do get a positive NPV project. So this implies that you should accept the Bahamas project. Any questions? Okay. So remember, this is all contingent on all of the assumptions we made in our about what's going to happen. And it's only as good a decision as are the estimates. This is just a slide to show you, you could calculate the cash flows for the project by putting the 3 together, right? The income cash flows, the investment cash flows, and the tax shield cash flows. And that would give you like just everything that we've been doing to this point. You know, I would give you a set of cash flows, there they are, and you evaluate the project. You can calculate the NPV with those numbers. You're going to get the same number we got doing it in 3 parts. And you can calculate the internal rate of return. What is the internal rate of return of these cash flows? So if you put these into your cash flow keys, you'll find the internal rate of return is what?
No answer? You didn't do it? Forgot about my frequencies. Did you guys get that? The answer is 10.25. Okay. Okay. So 10.25, 10.26. And because it's an investment project, the first cash flow is a negative, and the internal rate of return is greater than the required rate of return, we invest, right? We should have the same answer, whether we use NPV or IRR. Okay. All right. Any questions about the case? So we solve the case. We should invest either, the IRR or the NPV should give you the right answer. What if
I introduced inflation of 4%. If there's inflation of 4%, remembering that the cash flows that I give you are always nominal, right? Unless I specify that something is real. Now with the nominal rate, you have to use the nominal rate that must be used to calculate the nominal cash flows, to find the present value of nominal cash flows. But if you use the real cash flow equivalent using this expression, remember how to compute by deflating each of the nominal cash flows as many years as you need to get the real equivalent. So in the first year, they're going to be the same, or immediately it'll be the same. And then at the end of the first year, discounting it's not discounting, it's deflating them, making them real cash flows. And I'm going to do that for all these cash flows and create this new chart. If I use, so this is just part 1 and 2 that I've put here. We don't do the same with the tax shields, however. We leave the tax shields as nominal. Tax shields are a stream of nominal cash flows. We don't think of them as real. They must be computed with the nominal rate. So whether you use the nominal amounts or the real amounts, as long as you use the nominal rate with the nominal amounts and the real rate with the real amounts, you should get the same results as we already computed. Shouldn't be a problem. Just a point that with 4% inflation, the real rate will be 5.769%. So the only thing that remains in these notes are this discussion about the real and nominal interest rate. I think I did this discussion with you. We did do this discussion together, I think. I recall. Let me verify. Yeah, we got to talk about that. Okay, so we talked about everything. Okay, so I gave you a series of problems with answers to practice solving cases. Does anybody have any specific questions for me about it? About any of those exercises? So we have a half an hour. We can just solve some parts. But essentially it's the same thing. It is the same thing. I'm wondering if I need to give you guys more time for the test. How do you feel about that? I have 5 students, 4, because I'm one of the watchers. How do you feel if I was to give you more time for the test on Wednesday? Like, I mean, in terms of days, not just hours.
Are you listening? No comments? Okay, interesting. I'm just going to get out a case. Okay, what I want to do is solve the test question that I posted as the old exam. I'm going to open it up. Ricardo likes the idea. No, not change the test date, but just give you more time. So I'll give it to you on Wednesday, and you can give it back to me on Friday. You have a few days to prepare your answer, rather than just in the class time. How does it sound? You're basically making the decision for the rest of the class. So let's have a vote. Who says yes? They like a few days to complete the test as opposed to deadline. What I might do is maybe I'll make some multiple choice questions for the hour of the test, and then the second part of the test to submit later, so I can give you actually a case and you have more time, because there's no way to finish a case in an hour and a half with other questions. So there'll be two parts, one part multiple choice and then one part long answer. Okay, we have 2 votes in out of 6. How many more are going to vote? Thank you, Paula, Alejandro, Kichi, if I said that correctly. I'm trying to position this. Okay, Alexa. All right. So you guys, let's do that then. All right, so I wanted to look at, can you see? It looks a bit blurry. So at the end of this, this is on the platform in Moodle. It's very blurry looking to me. So when it's blurry, just reload. That helps. And there you go. Yeah, what does that sound like, Alejandro? So the long answer part of this old exam, if you can find it online. The problem with solving these problems is we need time to read it. So you need to take time to read the case. So what we'll just do right now, let's do this one together. I'm just assuming you haven't looked at this yet. So I got this from the platform. Unit 4. And old exam. If you have the solutions to all of these, you should be studying. Alejandro, I didn't get your vote. Are you thinking about it still? Oh, you did say yes. Yeah. Okay. So that's where I got it from, okay? Right here. All right, so let's spend 15 minutes, that's all we have, to look at which are incremental cash flows and divide it into investment income and income cash flows, all right? And then obviously we'll find that the investment, the capital, or the asset that will depreciate if there is one. So your company has been considering introducing a 4-year-long computer hardware. On January 1st, 2023, oh, that's a typo, is considering implementing a recently developed recycling process named EnviroClean. This is a typo. I don't know. Sorry about that. I should clean that up. EnviroClean. Glass Inc. GI's original UltraCycle process cost $20 million to implement on January 1st, 2020. In the old UltraCycle process, glass is crushed, melted, and then recycled into new glass products. In the proposed EnviroClean process, crushing the glass is unnecessary. Using new technology, the EnviroClean process, glass is directly melted and then recycled into new glass products. Given some similarities in the two processes, it is estimated that 10% of the cost of the original UltraCycle process is attributed to the cost of developing the proposed EnviroClean process. So is there any cash flow information in here? Let's see. I'm just looking at Paula's question. Review 3, number 5. I'm a little bit confused what review 3. Review 3, number 5, you say? But problem 5 on review 3 capital budgeting. Oh, I must have opened an older version of this test or something. It doesn't look. Not sure. Review 3 doesn't have a number 5 on it, Paola. Don't see a number 5. I just see a case. So maybe you're telling me the wrong one. Review 2, number 5. Paxton. PCL, number 2. Let's see if I have PCL somewhere else. Okay, yeah, it looks like PCL is not there. Is that the one? Okay. Okay, so, oh wait, out of here, you have $20 million was the original cost in the past. This is a sunk cost and doesn't go into our analysis, right? So we don't worry about this amount. Then it is estimated that 10% of the cost of the original ultracycle process is attributed to the cost of developing the proposed EnviroClean process. Do we include that in the project analysis? This would be like an allocated cost, but because whether or not, taking on the EnviroClean process will not change the fact that this amount was spent, 10% of the cost is part of the development of the proposed EnviroClean process. So that's also going to be seen as sunk cost. Okay? Do that again. As a financial assistant with Glass Incorporated, you have been asked by its CFO to provide her with the information she needs to decide whether or not to take on the proposed project. If the analysis is in favor of this newly developed process, the new project will start at the beginning of next year. Oh, this was like last year. I should have made it 24, right? So just imagine that this is a year ago. Given the rapid development in recycling technology, it is anticipated that the EnviroClean process will be viable only for 5 years. So this is the duration of the project.
You are told that GI's fiscal year end is December 31 and that the required return for the project is an annually effective 26% and its corporate tax rate is 40%. So this is going to be the required rate of return. It's very high, right? Higher than we've seen. So we need all those pieces. The proposed project would require the use of one of GI's abandoned warehouses as of January 1st, 2023. Similar warehouses are rented out for $1,000 per month, paid at the beginning of each month. Does this go into our analysis? Yes, this is a opportunity cost, right? So if we have a warehouse, they're rented out, but we're not going to rent it, we're just going to use it for us. So this is an opportunity cost. And for each month, so you see, there's some of the cash flows to consider are annual, some of them are monthly, and this is forcing you or encouraging you to use annuities to solve this problem, not a Excel spreadsheet. The cost of partially automating the operations of the warehouse will require new machinery. Okay, so this amount, so let me get this amount and then this amount. The $35,000 equipment is the capital spending or the initial investment, right? This machinery will be depreciated using 7-year schedule. I'll underline that because we need that information. Upon completion of the proposed project, the new machinery will be sold for a value equivalent to its UCC. So this is exactly like we did in class. So you'll need to find that UCC. You have to basically do that chart to find the book value. And you find the book value, and that will be the salvage value. 10 employees for the proposed project will be hired to begin work on January 1st. Each will work 170 hours per month. They will be paid at the end of every month at a wage of $15 per hour for the duration of the project. So this is going to be an expense. Wow. So this is an incremental expense. Given the current labor shortage, this wage will certainly impact wages of workers currently employed in other operations of the firm. It's anticipated that the impact on current wages will increase expenses of GI's operations indefinitely. You see, so you're going to have to use annuity or perpetuity for this one. It's also incremental expense. So we only have a minute left. So what you need to do is read this whole case, identify all the incremental cash flows, and then where each one goes. So this first one will be investment. No, this will go into income. So this will go into 1. Capital spending will go into investment, 2. The book value, salvage value, okay, so that will go into the salvage value is in investment, part 2. Incremental expense will be part 1. Incremental expense will be part 1, and so on, okay? So you identify, separate, and then you can see there's a pattern. When there's a pattern, you can use annuities, and you'll see that in my solution. If you make a table, this item cannot go on the table because the increased expense is indefinite. You can't have an infinite table in Excel. You're going to have to use the annuity to calculate that for income. All right, so I'm going to stop there. I'm going to encourage you to look at all the cases. I'm going to give you time to solve a case for your test. But the first hour, or that hour and a half or hour and 20 minutes for the test, will be focused on solving problems in multiple choice type format. Okay, and I'll verify that I have all the solutions up for the cases that I posted. Any questions for me? Okay, well, all the best to you. I'll send information about the test so people won't be surprised with the format, okay? So take care, have a good couple of days studying, and keep me posted if you need any help. Take care. Bye for now.